Hi, welcome to my video on a balance sheet and how it connects to SAE records. So the idea is in this video we are going to cover the sections of a balance sheet and an income statement. Those are the two primary financial statements that records go into. So every time a student keeps records, they are the details. They are what back up the idea of a financial statement. So in this video, again, we're going to go over what a balance sheet is and what an income statement is, which those are reports. And then we're going to go into examples of how records, how entries, how financial transactions flow into those, again, financial statements. All right, let's take a look. Now, in my example here, I started off with a balance sheet. Now, a balance sheet's got three sections. First of all, these are assets. These are things we own. Now, they have to be equal to, there's no way to get this done otherwise, they have to be equal to liabilities, which are debts that we owe, or equity, which sometimes is called to be what's left over. But really what it is, it's made up of two sections. In fact, each of these has two sections that help define those. And so I'm going to go through each one again. Let's start over here with assets. So remember, assets are things that we own, and things that we own can be divided into two categories. The first is called a current asset. It's an asset that is easily to convert into cash. In other words, it can be easily made useful within a year or the operating cycle of whatever business. So things like current assets, the most liquid current asset, in other words, liquidity means the ability to turn into cash, is the cash account itself, like a bank account, savings account, checking account. Those are examples of a current asset. Current assets also are inventory that you have for sale. It also could be supplies that you plan to use or you could sell. Those are the ideas of current. It's stuff that's going to convert into money pretty quick or mature. Another example of a current asset is a young breeding animal like a heifer or a gilt, a young horse. These are items that are not mature yet and therefore have not completed their value change, and so they're called current at the time they're at that stage. Now, non-current. These are also things that we own, but they are long-term, like a breeding animal. In other words, you started out with a heifer. She's a young breeding animal. She's not mature yet. In other words, she could still be processed as a market animal. So she's kept in current until she matures and she's a breeding age. Then she's non-current. So cows, sows, trailers, land, building equipment, these are long-term assets that are planned to be used to hopefully make money, which would be a current asset. So non-current assets are things we own that are long-term. Current assets are things that we own that are more short-term. All right, so that defines the things that we own. Now, when we talk about how to measure these, we're going to go into the record keeping, but there is a term called a debit balance. A debit balance is a way to describe an asset. Now, debit is a concept of record keeping, meaning that it means plus or minus, sometimes people say. It really means what's on one side of the balance sheet and what's on the other side of the balance sheet. The left-hand side of the balance sheet has assets in it, and that is what's called a debit balance. Now, the right-hand side of the balance sheet, in other words, your assets have to equal, let's start with liabilities. Liabilities are things that we owe, debts we owe, and remember that could be current debt, which is less than 1 year, or non-current debt, which can be longer than 1 year. And those are defined as a credit balance, meaning that they're the opposite of our assets. We owe money. That's the opposite of owning an asset, is owing money on it. And so that's called a credit. So anytime you want to increase your debt, meaning you borrow money, that's going to be a credit. Anytime you increase your assets, like more cash on hand, that's going to be a debit. So debits and credits are always the opposite, and liabilities are the opposite of an asset. Now, the right side of the balance sheet's not done because there's another part of that, and that's called equity. Well, again, equity can be broken into two sections. The first is a net of what you've made in profit. So if I sell something for $500 and I spent $200 on it, that's automatically a $300 profit, and that will represent this part of my equity called retained earnings. Retained earnings is the net profit of all your years of profit or loss. Now, I also can get equity by beginning with something or having it gifted to me. So before I ever started my business, I had to contribute money, or someone gifted me money. It's called contributed capital. That's another type of equity. So equity can be either gifted to me or I can actually earn it, which is really the primary way you want to grow equity. So equity is also, just like a liability, it's a credit balance. Now, don't get confused. Liabilities and equity seem to not be, they seem to be very different. They're not the same, but they are credit balances because they are on the right-hand side of the balance sheet. So the balance sheet's divided into two parts. The left-hand side is assets, and that's a debit balance. Right-hand side is liabilities and equity, and they are both credit balances, and that way everything balances together. Now, part of equity is income. So equity is retained earnings, as I mentioned before, and that's your net profit. So what that means is that it's not part of your balance sheet. It's a profit and loss statement. But profit and loss every year is calculated and it's closed to retained earnings. So for example, as I mentioned before, if you have a $500 income, well, that's a credit because that's going to be very good for equity. So that's also a credit. They match. What causes income to go down is I have to spend money. That's a debit. Now, the opposite of a credit is a debit. So if you have $300 in a debit and you place it into this column right here, that's going to cause whatever the balance is to go down because it's the opposite of a credit. That's a debit. So the income statement, profit and loss, or income minus expense, is closed to here. So if you have more income, you got more credit. That's going to make this go up. If you have more expenses than income, that's a debit. That's going to make this go down. And that's why that is a credit balance. So the idea about debit and credit is very simple, is that debits and credits need to equal each other to have a balanced balance sheet. That means that your assets on the left-hand side are a debit and anything on the right basically is a credit. And then retained earnings is kind of by itself, and it represents the net results of income minus expense. All right, so that's kind of the idea of the balance sheet. Now, as we keep records, these rules of debit and credit have to be followed. If not, then the numbers you report into the balance sheet or the income statement could be incorrect. In fact, if they don't balance, they are incorrect. So the idea of accounting is it's a set of rules that helps you organize your entries. That's really the idea of online records or an automatic record keeping system like AET. Every time one entry is made, then the record book knows the opposite entry and can make it for you to help speed up the process and to keep your books accurate, which is really the function of record keeping. Let's look at some examples doing it the old-fashioned way by hand. So if I buy a breeding animal with cash out of my account, that means that my first all is what's the debit. So the debit is I bought a new breeding animal. That's a non-current item. So let's say I bought a new breeding animal for $1,250. Well, I don't balance right now. All I've got is a debit for $1,250. I need a credit. Did I borrow the money? No. Did I get someone gift me the money, or did I affect income and expense? The answer is no. I took cash out of my bank account. So the debit is a new asset, but a credit comes right out of the assets, which is going to be a negative number for us. And this is how it's illustrated. So the idea is we are debiting our assets to make them go up, but we're having to do a credit to the same assets, cash on hand, our bank account, down by $1,250. That's a credit. That's the opposite of a debit, makes it go down. So now our debits and credits equal each other, and these two offset to be in balance. Now, what about if I sold that breeding animal, let's say for the same money? If I sold that breeding animal, then I got $1,250 back in my bank account, but that asset, that $1,250 asset, has to have a credit to it now to take it out. So that's where the negative would come from. And again, I am now completely and still in balance, 0 and 0. Now, what if we back up? What if you sold that breeding animal? Get rid of those. What if you sold the breeding animal for, let's say, $1,500, meaning we made $250? I'm ignoring depreciation, but let's say you made $1,500. So $1,500 goes in my bank account. That's a debit, which makes this go up by $1,500, right? And I had an asset worth $1,250. So if I hit a credit on that, that comes out at $1,250. I am off by $250. I do not balance. So then the question is, where does that money go? So you got a debit for $1,500, credit for $12.50, you need another credit. Is that a borrowed amount of money? No. Is it a gifted amount of money? No. Is it something that affected my income? Yes, I made $250 extra. So you don't put it here in your balance sheet. You have it over here as an income. So that's another $250 of income. And so now that credit ends up showing up here as a credit because I don't have any expense with that. So now if you come down here, there's your $250 debit equals the $250 credit balance, and you're already in good shape. All right, so the idea about debits and credits, and it gets complicated as you make these entries. Again, the whole point of an online or a updated new financial management system is that it tries to help you handle all of these entries based on the way you answer common questions. Like, I sold a breeding animal. The record system will know how much you have in her, what's the value. So then it's going to ask you what you sell her for. So it's going to know that that's a profit. And it's going to place these entries for you by answering simple questions. All right, what about a situation where I buy a new truck? So that's a new non-current asset for, let's say, $35,000. And I bought it with a loan, so that's a long-term loan. So that's a debit to the assets and a credit to the liabilities for the same amount. And so now everything balances. I've got a debit and a credit that equal each other. All right, if you get a gift of a trailer, let's say you got a $5,000 trailer. Once again, debit the asset where you get the trailer. Debits are usually first. And the question is the credit. Did you borrow that money? Nope. Did you earn that money? No. And so you must have got that money as a loan. And then finally, what about expenses? So if I have to pay expenses, and I'm just talking about paying expenses with cash on hand, then that means that the debit is going to be the expenses. They're a debit first. So $200, let's say I spent, and that came out of my bank account. So that's a negative $200 out of the bank account, which would be a credit because that's normally a debit balance. So I got a credit of 200 matches the debit of 200 as an expense. Then I'm set. All right, next one, I sell the crop, and so I got some expenses of $200 to get my vegetable crop ready. I sold $500, debit $500. What's the credit? Did I borrow that money? No, I sold something. Did I get it as a gift? No. Did it affect my profit? Yes, but you don't make an entry here. You usually don't make entries into retained earnings. You go put it where it goes, which is income of $500. So now, debit $500, credit income $500. So the idea is, and of course that would be then, it looks like to me that I've got $500 and $200, so that's actually $300 here. That's the credit that goes along with that. All right, so the idea is that a balance sheet, assets equals liabilities plus equity, is the normal balance of all records. There's no way to break that. That's the only way you can enter records. Now, to make sure that we get equity right, we have to get our income and expenses right. So what this example I'm showing you is called a trial balance of financial accounts. Every time entries are made into a record system, this is what has to be done to make sure everything balances correctly. The idea is online record systems help handle this for you, but it's very important to understand, first of all, the concept of the balance sheet. The concept of profit and loss and how that connects to what's called retained earnings, which is listed right through here. And then the idea behind all of that is understanding that assets are a debit, liabilities and equity are credits, income's a credit, debit's an expense, and how all of that connects into every time records happen. All right, so hopefully in this video you understand more about the balance sheet and its purpose. Hopefully also you understand the income statement and its purpose and how it connects to the balance sheet. Those are important concepts that you need to hopefully grasp. The other part is hopefully you understand a little bit about debit and credit. So that's how entries are made into a record system. All right, hopefully this video helps you again understand those concepts. Take a look at the other resources and let me know if you have any questions.